Good afternoon, everyone. I'm Jacques Conradie. I'm the CEO and one of the fund managers at Peregrine Capital. It's fantastic to see all of you here face to face. I mean, it's the first time we've been involved in this event, seeing everyone face to face. So it's really a great change from all the Zoom meetings and Teams meetings we've had over the last year or so. So my presentation today is titled "Digging for Diamonds." And what I want to do today is try to give you some insight as to how we as Peregrine Capital, a hedge fund business, how we pick underlying stocks and how we put together the pieces of the puzzle that generates the returns we have done over time for investors. So first to start, our business is the longest running hedge fund in South Africa. We're 23 years old and we started on the 1st of July 1998. The business was started with the mission of creating wealth for our clients. And we do that by generating excess risk-adjusted returns, so being very focused on generating outsized returns, but while at the same time managing the downside risks. And on a day like today in markets, I'm sure all of you are watching it, I think having that risk management hat on is as vital as the returns you generate. So on the slide, we try to break it down into 5 blocks to give you some insights into the key parts of our process. My belief is always that as a fund manager, you've got to do many, many things consistently right to generate strong returns, but we're going to try to touch on just a few of these on this slide. So firstly, we invest only in our very best ideas. Our model is different from the typical long-only asset manager, where a lot of the staff are there as a job, they're there for the money they earn on a monthly basis. In our case, you'll find our directors, shareholders, and fund managers have a material portion of their own net worths invested in our funds right alongside clients. So we really see our business as managing our own money with client money alongside ours. And with that hat on, you're never going to buy a share just because it's in an index or it's a certain size market cap. You're going to buy a company because you think that share in its own right is mispriced and can generate excess returns for clients. It links very tightly with the 5th block here. We are just not benchmark-focused investors. Every idea has got to stand up on its own merits. The second point is vital. We only invest in businesses that we understand. Our goal is for any company in our portfolio, and especially large-sized positions, we want to know that company and that business better than anyone else in the SA market. And a few of the slides today, later on when we go into specific opportunities, should hopefully give you some insight as to how we try to create that. Finally, the 3rd block here is very apt right now in this part of the market cycle. We went through a 5 or 10 year period where people actually forgot that valuation is the core underpin to making an investment decision. You all will have seen Cathy Wood and her ARC business and lots of the tech funds globally being the outsized performers until about a year ago in markets. And they made it seem easy. They made it seem like you don't need to do valuation. You can just invest in the most exciting companies with the fastest revenue growth, and you don't have to care about profits or valuation. The market's changed very quickly, and I think ARC's probably down more than 70% from the peak in February 2021. So our core underpin will always be, what is a business worth, and where can you buy that at this point in time? So our job as fund managers is actually very important. Most people think your job is finding the most exciting companies. That's actually not the job of a fund manager. It's finding the most mispriced companies. You can make much more money from a boring company that's way mispriced than from an exciting company with fast revenue growth that's way overpriced. And the 4th block here is another key differentiator for us in the SA market. We embrace and love situations that are complicated, that are difficult to analyze, and that require a ton of work. Most long-only managers will stick with the easy opportunities, with companies that's easy to understand, easy to model. We love opportunities where you've got to go through hundreds of pages of documentation, figure out how structures work, figure out how the cash flows are going to work, because we know most people are too lazy to do that work. They'll simply avoid those opportunities, and that often leaves them as pricing. And we've got an extremely high hit rate on these kind of opportunities. So let's move on to the stuff I love, the specific bottom-up opportunities. So the first one here is Thungela Resources. When this company unbundled about a year ago from Anglo American, I don't think it was particularly well known or particularly well flagged on the JSE. I think right now, I'm sure many more of you would have heard about it, given what's happened in the last year. But I'll just give you some context to the story. So Anglo American received lots of shareholder pressure to unbundle their coal assets for ESG reasons. So they announced this unbundling early last year, and I think at around June, Thungela was unbundled from Anglo American. So this effectively would be a new listing. And as I touched on earlier, any new company listing on the JSE, we want to make sure that we hopefully know that company as well or better than anyone else participating in that share. So the typical manager here, what they'll do is, they'll go through the financial statements published on the company, they'll have their one meeting with management, and they'll chat to a few of the sell-side analysts on coal, which is a fairly reasonable way of doing things. However, our edge and our approach goes significantly deeper. I think on Thungela alone, we've had more than 100 interactions and probably getting onto 200 now with various people in this industry to make sure we understand every single part of it. So firstly, we also did the meetings that most of the other analysts and fund managers in the industry would do, but we then went further. We found the leading Chinese coal experts, given that China is the biggest global importer of coal, so a lot of the coal goes there. We spoke to them, we set up calls with them. We delved into the big Indonesian coal exporters' results calls. They're the biggest exporters of coal, so that helps you understand the global supply-demand situation on coal. And then the key issue for the current coal producers is the underperformance of Transnet, how you rail your coal from the mine in Mpumalanga to the Richards Bay coal terminal to export that coal. So we set up various calls all the way from the CEO of Transnet to various people in the company to understand what's going on in the coal line and the prospects for improving performance on that line. We also spoke to SA coal mining experts, global players in the sector, the Mineral Council, and even interacted with various ministers around the resources side and around the Transnet side to see if we can add some value and help get South Africa on track. Because this Transnet underperformance is causing massive cash flow losses for the country as a whole. Those are dollars that could have been coming to rands. Those are tax revenues and royalty revenues we could have earned. So what happens then is you do all this work, but you still don't know if the share will be an opportunity, because you've got to do this before it lists, right, to be ready on the day of listing to take action, because that's going to be the day where people will either sell or buy. So you do all this work. We did this in May or June last year, and you form a fair value on this company. So at that stage, our fair value on Thungela was 60 to 100 Rand a share, and then you wait for day one to see what happens on listing. So maybe one additional point of context here around the listing, and I guess what gave us a clue that will most probably be an interesting one, is that Anglo American's market cap was 750 billion Rand, and Thungela coming out was a tiny piece, only 3 billion Rand. So effectively, you had less than 0.5% of Anglo being unbundled to shareholders. That means that if you're a global fund with a 2% position in Anglo, you get 1 basis point in Thungela. That's not 1%, 1 basis point, 0.01%. So what are you going to do? You're not going to do the work on the company. You're simply going to sell it within the first week or two of getting it. So because of this forced selling, we got an amazing opportunity in that first week to buy Thungela at about 25 Rand a share on average and ended up buying about 5% of the company in those first few weeks. And I guess it's the confidence that you've done the work that helps you make this decision, because there was a ton of volume, about 100% of the company traded in that time. So you better be sure you've done the work, because there's a lot of other people telling you you're wrong. They're selling you, they're filling your orders. So you've got to have the confidence that you've done the work, that you hopefully know more than the seller in this scenario. I think that the other interesting thing before we get on to how it worked out is how important it is on your side when you pick a fund manager to be aware of their total assets under management and to understand how that impacts their flexibility. So Thungela on listing was 3 billion Rand in market cap. So our high growth fund, that's our flagship fund, is about 6.7 billion Rand. So this means that if we want a 2.5% position in Thungela, which is kind of a standard medium-sized position for us, we've got to buy about 5% of the total company to get to that position. Now 5% is a meaningful holding and it takes you some time to get there, but you can do that. However, the position I wouldn't like to be in is one of these very long South African long onlys. Because in that scenario, your balanced fund is 150 billion Rand. Even if you buy 5% of Thungela, that's 150 million Rand, that's 0.1% or 10 basis points of your fund. So what happened in the first 6 months of us owning it is Thungela went from 25 to about 100 Rand to the top end of our fair value range, and it was a spectacular return generator for us with about 7.5% of alpha contributed to our funds. If you were long only, if you saw all this, you did the work, you prepared for it, your 10 basis points went to 40 basis points, and you made 0.3% of alpha. So it just shows you how relevant and important it is to pick a manager that's the right size to take advantage of these opportunities. Because inevitably, shares that go up 5 or 10 times are not the largest companies on the JSE. They're already very large. Your 5 or 10 baggers often sits in your medium and small size companies. So this is super relevant for building a position before those companies go up 5 or 10 times in size. So for the next opportunity, I want to touch on another theme on our side, and that's the difference between a top-down manager and a bottom-up manager. So a lot of managers look at the world from a top-down perspective. They look at macro events, they look at economies, and they find sectors they like. We also invest with that hat on, but all our positions are primarily driven by bottom-up research. So let's look at the food producer sector right now. If you looked at that sector from a top-down perspective, it's easy to find all the reasons to avoid that sector. The consumer is currently constrained. It's not like things are going spectacularly, and especially the middle or low end are constrained on cash. There's massive massive pressure on input costs coming. The Russia and Ukraine situation and the war there has caused severe pressure on food prices. Ukraine's one of the biggest wheat exporters in the world, and that's going to feed through the entire food value chain. It's very difficult for the food producers to pass on this pricing. As we know, the food producers are companies like Tiger Brands, like AVI. They make the bread we eat, the chicken we eat, biscuits, the coffee we drink. So all these are made, obviously, with the key food raw materials. And it's hard for them to pass on that pricing right now. And finally, there's a real lack in volume growth in the sector due to the SA's 2 or 3% weak GDP growth we've had for many years. So if you were bearish food producers, you'd be right. Over the last 3 months, since the war started, Tiger Brands, which is the biggest player in the sector, down a bit more than 10%. I think where it is today, it's probably down another 5 or 10% from where we did this graph. So the big top-down perspective would have been right, and it would have been the right call to avoid the sector. However, with the bottom-up hat on, there was a specific company, Astral, that massively outperformed in that time. It's up about 30% in the same period, leading to massive outperformance of Tigers if either you had a pair trade on or you just avoided Tigers and you owned Astral. So let's look at why this is the case and why bottom-up investing matters, even if top-down tells you to avoid a sector. So we think the Astral management team has done an amazing job executing in the chicken business. They've consistently been focused on being the largest and lowest cost chicken producer in SA. Chicken's a cyclical business. Your major inputs into producing a chicken is maize and soybeans. So in times when maize and soybean prices are high, typically your chicken margins go down, and that's when people try to cut back production or they often fire staff. Every one of those cycles, Astral has continued to add capacity and continue to invest with the view that they'll then take market share in future cycles as those prices eventually come down. So where they are now, they are by far the lowest cost per chicken producer in South Africa. In these last 6 months, even in this tough economy, they thus grew volumes by 16% and now produce 5.8 million birds a week. So basically every month they roughly produce like 1 chicken for every 2 South Africans. Truly spectacular size that they operate this business at. Additionally, what's also happened in this time that's benefited the chicken industry is that governments introduced import duties on Brazil dumping their excess chicken supplies in South Africa. We think this is a vital action from government, as the war in Ukraine right now, I think will make the world absolutely clear on the fact that as a country, having food security ticked, where you can produce enough grains, enough protein for your own population, will be absolutely vital. We think globalization has probably peaked in the short term, and for the next 5 or 10 years, countries will look after themselves first before thinking about exports and imports. So you've got to make sure your country can look after itself, and I think it's a very wise decision from government to support the local industry and ensure that we can produce enough chicken for our own population, as well as many other food commodities. So the result of this is that earnings are up 146% in the last 6 months, and even after the 30% run, we're still only trading on about 6 times earnings and a 10% dividend yield. I just want to get onto this point about relative size again, to then show you the added constraint of how you build a position like this. This is a list of just a few companies in the JSE and their average trading volumes per day. And you'll see here that obviously Naspers and Prosus are the largest. They trade about 1.5 billion rand a day. And then there's a next tier of companies trading about 1 billion rand a day after that, with several others in the 500 million rand category. So if you want to trade in these companies, even if you're a large manager, it's fine. You can move reasonable volumes and you can buy the position you want. However, if you then go onto a mid-cap like Astral, and this is the case for many other mid-caps, it trades about 20 million rand a day. So very different from the billion rand plus that Naspers trades. So what does this mean? Again, let's say we want to build a 2.5% position, which we did a few months ago when we saw Astral was attractively priced. It means we need to buy about 870,000 shares in this scenario. Again, assuming a 100 billion rand fund, and there's obviously many larger asset managers out there than that, at that share count, they'd only be 0.2% in Astral. So again, even if you call it right, it's not going to make a difference to your fund performance. Were they to try to get to 2.5%, you'll see here that you end up having to buy all the Astrals that trade every day for 100 days. Practically, that's not really possible. You can typically, over time, trade about a third of the daily volume in a share. So it means you've got to be buying the share for a year to get the right entry point. And practically, shares that are cheap don't stay cheap for a year. It just doesn't work that way. So again, you've got to be nimble here. On our side, it took us probably 2 to 4 weeks to build a position, which again is somewhat long, but it's a reasonable period of time. And typically, you have that window for shares to build that kind of position. So my final example here is to illustrate specifically the wider hedge fund toolkit that's available to us and how we can use that to generate returns for investors. So obviously the key difference between a hedge fund and long-only manager is our ability to go short. And we can use that to hedge the portfolio, but also to create trades like the one I'm going to discuss now. So Rand Merchant Insurance has been listed on the JSE for the last 10 years plus. Many of you might know this company. And the key assets in this are 25% of Discovery, 25% of Momentum Metropolitan, and then about 90% of OUTsurance. We think OUTsurance specifically is a unique South African business. It's, in our opinion, the top 5 SA company listed on the JSE. Why do I say that? We think their pricing engine to price motor insurance risks is absolutely world-class. Their underwriting margins, or their profit margins in their motor business, is one of the highest in the world and has been consistently so for the last 10 years. Additionally, they're fantastic brand builders. They've built an amazing SA brand out of scratch in the last 20 years. And I think what proves that their recipe works is the fact that they've been able to go to Australia 10 or 15 years ago, build a brand there called UE, that's now 5 or 6% of the very large Australian market. And as you know, very, very few SA companies has been able to take their models and export them offshore. And I guess the fact that OUTsurance has been able to do this must indicate to us that it's a really, truly unique competitive advantage. The other great thing that we love in all the companies we invest in is that earnings converts to cash and they pay it out in dividends. I mean, Discovery here is also a great company, but they haven't got the cash conversion. They've got cash that they generate, or they've got earnings that they generate, but the cash isn't really there, so you don't get a dividend yield, and they're permanently tight on their cash flow. So for that reason, we specifically like OUTsurance in this bucket. So what does this mean for a hedge fund versus a long only? Over the last year, RMI has decided to simplify their structure. They traded at a big discount to their sum of the parts, and they said, we're going to unbundle the Discovery and the Metropolitan to investors so they can own those directly, and in the end, we'll only be left with OUTsurance, and eventually we'll rebrand ourselves to OUTsurance Holdings. So this was super exciting for us, as we knew finally the market would be able to access this amazing business on an outright, in a pure play outright fashion. And I guess knowing how investors think, we think this will be a very attractive asset for long-only managers in SA to own, and for global investors that want to own the best quality business in SA. They'll want to own OUTsurance. For me, it's like a Capitec, it's like a Clicks, like a Dis-Chem. It's those high-quality SA businesses that trade at very high ratings. So as a hedge fund, the real benefit we have here is even a year before this transaction happens, we can own RMI and we can short out the Discovery and the Metropolitan that we know we will get. You can short out the exact number of shares you'll get. So when the eventual unbundling happens, like happened in April this year, your unbundled share just nets off with the shorts and you effectively are left with your pure play OUTsurance. So I mean, let's just look here at what OUTsurance has achieved over the last 15 years and what we think will happen over the next 3 or so years. It's been a real spectacular success story. Almost 500% earnings growth over the last 15 years. And as you'll see here, we think they just have gone through a J curve in Australia and in their business insurance. So we think earnings will massively ramp up over the next 3 or so years. So very, very well positioned because of the factors I mentioned earlier. This is how the share is done. What I've done here is I've given you an indication of how we look at this instrument. So the last 2 months or so is just the actual RMI share price that you can all track on the JSE. But before that, what the graph does is it tells us the instrument we've created by owning RMI, shorting Metropolitan, shorting Discovery against that, and creating OUTsurance before it's available to the market. So you'll see in a fairly tough market, fairly tough JSE, it's up about 100% almost, from 14 Rand to I think 28 Rand on this graph. It's trading at about 26 Rand 50 today, and you've gotten a nice special dividend in that time. So you'll say, sure, but long-only managers can buy this as well now. Well, yes, they can, but you'll see the bump in the graph here kind of at the start of May when the unbundling happened. So if you were a long-only manager, again, if you did the same work as we did and you saw this opportunity emerging, that's the moment when you can buy OUTsurance outright. So you could have made the last 10%, but unfortunately you missed the first 90% of the trade because of that wider toolkit that's not available to you to create this type of opportunity. So I'm going to end off by just giving you some insights as to how this stock picking process and the kind of shares we pick then combine to create the overall portfolio, and also give you some insight into how we think about downside management and risk management. So firstly, let's look at the track record. So this is our flagship high growth fund that started in Feb 2000. And I guess it's probably our most proud achievement that we're the first SA fund that's done 100 times money for investors since inception. So if you invested R1 million in high growth on 1 Feb 2000, you'd have more than 120 million Rand where we are right now. And I guess an important thing to address is, if I speak to people about hedge funds, the first thought that often comes to mind with people that's new to the category is that hedge funds must be more risky than the typical long-only manager or balance fund. And that's certainly not my view, and that's not how we run our funds. Hedge funds have a wider toolkit available, but if you've picked the right manager that knows how to use those tools, a hedge fund will typically be lower risk than your average equity or balance fund. And I think our track record clearly demonstrates that. I mean, I'm probably as proud of the fact that we've done 100 times money as I am of the fact that there's been very few major drawdowns on this graph throughout this time. So I guess generating strong returns while also keeping your clients comfortable, giving them no reason to panic, and making sure that even in tough market environments, they achieve reasonable performance is a key part of getting clients to stick with you and be investors for the long run. And I think one final thing that this shows is that if you find the right manager that can deliver consistent outperformance and alpha, the importance of sticking with that and letting that compound year after year, that's really how you get the big winners. It's almost similar to us picking stocks, and if you find a real great compounder that's going to grow earnings fantastically over time, I mean, we had Capitec in the fund for many, many years, you just stick with that and you hold on to that and you let the company do the compounding for you. So just another slide to touch on this point about risk. What we did here is we took the 5 largest unit trusts in South Africa. So these will mostly be large balance funds, large equity funds. And we did their correlation over the last few years with the overall JSE Cat Swix index. And as you see here, they're all pretty much 70 to 90% correlated with the market. So even if you diversify client portfolios among large long-only managers, you're actually getting much less in diversification than you think because of the fact that these companies are so, or these funds are so highly correlated to the market. And again, it touches back to that earlier point I made around fund size. If you're a very big fund, you unfortunately have to play in the top 20 or the top 40 shares. And that causes very similar positions at the end of the day in many of these funds. I think what you'll see here is our high growth fund is only 40% correlated with the market, or 40, 50% correlated. And then the pure hedge fund's only 15% correlated with the market. And the reason that's different is, firstly, the type of companies we invest in. We've got a wider universe in SA. We can probably take 120 or so companies and have meaningful positions in them in the funds. And then also the way we risk, the way we manage risk, the way we use pair trades, the way we short individual shares, and the way we manage downside risk. So what we really want to do with this fund is ensure that it's a product that if you add it to a mix of client portfolios, it'll both increase the expected return of that fund, while at the same time having lower correlation with the existing managers in there, and therefore improving the volatility and reducing the drawdown of your overall client portfolios, especially in times of stress. I mean, I'll maybe just take the slide to chat about our current market view, which is really fairly cautious. I think it's a great time to be looking at hedge funds, because where we are right now, we think it's the first time since the global financial crisis in 2008 that there's real potential for an extended, very tough bear market environment. Most investors that's come into the market over the last 10 or 15 years are simply used to a market where every time there's a 10 or 15% pullback, the Fed will just bail you out. There inevitably was a Fed put in the market where the moment things look slightly ugly, they'll just do more QE and they cut rates and everything is fine again. So everyone has been conditioned to just be buying the dip, just buying the dip. However, obviously all of us are aware of the massive inflation pressures globally. I mean, we saw again a new kind of 40-year record inflation print on Friday at 8.6%. So what you've got now is inflation is by far the biggest issue in any developed market right now. And unfortunately for central bankers, this has become a political issue. If Biden and other politicians don't sort out inflation, they are simply not going to be re-elected. And we all know that politicians primarily and only really care about re-election. So right now, inflation is a much bigger issue than protecting the overall level of equity markets, which means there is no central bank put that's going to save us this time. They simply have to get rates high enough to slow down demand, to slow down the inflation we're currently dealing with. And that is just a setup for a market environment that has got to leave you very cautious. So the way we're thinking right now is you want to run much higher cash balances than you've done over the last 5 or 10 years. Have cash available to deploy into dips. You want to play in companies where there's cash on the balance sheet. You want to avoid companies with debt as rates go up. And you generally just want to have the hat on of protecting clients' downside, protecting the overall fund, and being there if things fall another 20 or 30%. You want to be the one sitting with cash, deploying money in that market right then, rather than the one that try to pick the bottom too early, is way down at that stage, and then panic sells at the low. That's kind of our mindset right now. Try to protect client funds and be well positioned if the bear case scenario plays out. For the final slide, I think this is just a summary of how everything basically comes together into the returns we've generated over time. You'll see here I've got various performance measures, year to date, 1 year, 3 years, 5 years, 10 years, 15 years, and since inception, with the blue bar being the high growth fund, the red being the multi-asset high equity category, and the gray being the overall market. I think that the year-to-date number has changed so quickly in this last week. So where we're sitting today, I think the market's probably down about 10% versus still up 2 or 3 on this. I think pleasingly for us, I mean, growth has felt some of that, but we're still sitting up 2 or 3% at this point in time. And I guess that's really what we want to do. In these kind of peak drawdown periods where clients are losing money everywhere else, make sure that you're the thing in the portfolio that does better and that absorbs that shock in client portfolios. But then moving back to the long term, our goal really is to generate consistent kind of 5% plus outperformance versus the balanced fund category. And pleasingly, over almost all of these time periods, we've done that, and in some cases, some more. Right, so I'm going to leave it there. Thank you very much for giving me your time and for listening to us. Good luck out there. It's certainly going to be interesting markets in the 3 or 6 months ahead. Yeah, please reach out to us if you want to speak. Visit our website, follow us on LinkedIn. We're very happy to talk. And otherwise, good luck out there and good luck with managing your client portfolios in this difficult time. Thank you.